Synthetix just handed me the exact same setup that delivered 4 winning targets earlier this year. Same accumulation range, same channel structure, same type of bearish sentiment, except this time the protocol beneath the token looks completely different. While most traders see a bleeding altcoin down 80% from highs, the data shows $2.5 billion flowing through Synthetix in 3 weeks, mobile trading going live, and 9 new markets launching in 7 days. I'm not calling a bottom. I'm showing you why this divergence between price action and protocol growth creates the kind of asymmetric setup I look for. If you caught my last SNX trade, you know how this played out. If you missed it, pay attention. The patterns are repeating, but the fundamentals are stronger. Let's establish where we are. SNX recently rallied from deep value territory all the way up to a major resistance level that's been respected since 2021. That resistance sits exactly where the descending channel's upper boundary lives, a structure that's controlled this token for nearly 4 years. Price got rejected hard, exactly as the pattern predicted, and we're now retracing back into what I call the accumulation zone. This is the same range where I built my position months ago, the same zone I shared with my community, and the same zone that eventually delivered 70% of my targets before hitting that ceiling. Current structure has price trading below every meaningful moving average on the 2-week chart. The shorter-term exponentials are sloping down, momentum looks weak, and if you're just reading candles without context, this looks like a token in trouble. Market sentiment reflects that. There's no hype here, no Twitter euphoria, no influencers pumping bags. It's quiet, which is exactly when the interesting setups appear. But here's what changed since my last accumulation. Synthetix the protocol is executing at a level we haven't seen before. This isn't the same project I analyzed 6 months ago. The activity, the product improvements, the real usage, it's all accelerating while price does the opposite. That divergence is what makes this worth examining. 3 developments happened in the past 2 weeks that most people missed because they're too focused on candles. First, Synthetix launched their Mainnet trading competition, and the numbers coming out of it are substantial. Over $2.5 billion in trading volume processed through the protocol during just the first 3 weeks. Not TVL sitting idle in a vault, not staked tokens collecting dust. Active trading volume from real participants executing real strategies. The leaderboard tells the story. Traders like Fung moved over $50 million in volume. Bodhi Ventures did over $70 million. These aren't bots farming incentives. These are sophisticated traders using Synthetix infrastructure because it works. The competition proves product market fit in real time, and the volume being generated creates actual protocol revenue. Every trade pays fees. Every fee accrues value to the system. This matters because it validates the business model under stress conditions. Second catalyst, mobile integration just went live for competition participants, with full public launch coming for all Synthetix exchange users. This expands accessibility in a meaningful way. Desktop-only trading limits your user base to people sitting at computers during specific hours. Mobile unlocks 24/7 access, enables trading on the go, and opens the door to different user behavior patterns. For a perpetual trading platform, mobile isn't a nice-to-have. It's essential for competing with centralized exchanges. Synthetix just closed that gap. Third development, 9 new trading pairs added in 1 week. First announcement brought Cardano, Starknet, Uniswap, Near Protocol, and Trump Coin, all with up to 100x leverage. 3 days later, another 4 markets: PumpFun, Zcash, BNB, and Pengu. Each new pair creates additional revenue streams through trading fees and gives users more reasons to choose Synthetix over alternatives. You don't launch 9 markets in 7 days unless your infrastructure can handle the load and your team is confident in the product. This is a protocol hitting its stride. There's also an ecosystem play happening with Infinex, extending their SUSD depositor rewards program. Users depositing SUSD earn weekly SNX distributions, plus raffle entries for NFTs and Ethereum prizes. This creates sustained buy pressure for SNX tokens, while simultaneously building liquidity for SUSD, which directly benefits trading conditions on Synthetix. More SUSD liquidity means better execution. Better execution attracts more traders. More traders generate more volume. More volume creates more fees. It's a flywheel that's starting to spin. What I'm seeing is a protocol executing across multiple fronts simultaneously. Proving demand through competition volume, expanding accessibility through mobile, growing available markets aggressively, and building ecosystem incentives that benefit the core product. None of this guarantees price appreciation in the short term, but it builds the foundation for sustainable value capture over time.
Starting with macro structure, because that's what matters most. SNX has traded inside a descending channel since the 2021 peak at $29, and that pattern remains completely intact. Recent price action tested the upper resistance of this channel around $2.50 and got firmly rejected, exactly what you'd expect from a valid pattern. That rejection confirms the channel's still in control, which means we need to respect the possibility of further downside if key support levels fail. The support zone I'm focused on sits between the all-time low, around 50 cents, and the upper boundary of my accumulation range at 80 cents. This is where buyers showed up before, where demand absorbed selling pressure, and where my previous position was built. Price is currently trading inside this green box on my chart, which represents the area where risk-reward starts favoring long positions if you have conviction in the fundamentals. Resistance above comes in layers. First major level aligns with the 236 Fibonacci retracement at $1.20. Levels measured from the December local top at 370 down to the June all-time low. This level has been tested multiple times and acts as a clear ceiling. Beyond that, the 382 Fibonacci retracement represents the next structural barrier. Both levels are marked with precision because Fibonacci tends to be self-fulfilling when enough traders are watching the same levels. Moving averages tell a bearish story on this time frame. Price sits below the 10 and 21 period exponential moving averages, below the 55 EMA, and below the 100 EMA. All shorter-term averages are sloping down or flat. For bulls to regain control, we'd need to see price reclaim at least the faster EMAs and hold them as support on retests. Until that happens, momentum favors continuation, lower or sideways consolidation. Heikin-Ashi RSI recently peaked in overbought territory during the rally to channel resistance, then reversed sharply back toward neutral. Current reading shows the oscillator still pointing down, suggesting additional downside pressure could materialize before a sustainable bottom forms. I'm not trying to catch a falling knife here. I'm identifying a zone where the risk-reward equation shifts in favor of patient accumulation. Volume profile analysis reveals the point of control at $2.60, sitting very close to where price got rejected at channel resistance. This high-volume node acts as a magnet for price. I've talked about this concept in previous videos. Price rallied up, hit the point of control, and sellers appeared in force. Now we're in a low-volume zone, which means price can move more easily in either direction without significant resistance. The question is whether we drift back up as a mean reversion play, or whether we sink lower to find the next high-volume support area. My position strategy is straightforward. The accumulation zone between previous lows and current levels is where I'm comfortable adding to positions. My stop loss is a weekly candle close below the descending channel's lower boundary, currently sitting near the all-time low area. If price breaks the channel down and confirms with a weekly close, the 4-year structure is invalidated, and I'm out. No ego, no hope, just structure. Take profit targets remain consistent with my previous trade. First target around the psychological level at 95 cents for conservative profit taking, then 120, 170, followed by the previous rejection high at 250, the December local top at $3.70, and finally a moonbag targeting the $5 to $8 range if Ethereum breaks into a euphoric phase above 8,000. These aren't random numbers, they're anchored to Fibonacci levels, previous resistance zones, and volume profile nodes. Each target represents a place where I expect selling pressure to appear. The technical setup is classic. Established downtrend channel, price returning to proven demand zone, fundamentals improving while charts look terrible. This is the definition of a contrarian setup. Either the improving fundamentals eventually pull price higher as the market recognizes the value being built, or the technical pattern wins and we break down to retest lower levels. That's why position sizing and stop-loss discipline matter. Best case scenario plays out like this. Price consolidates in the current accumulation zone while the protocol continues executing. More volume, more markets, more users. Eventually, the market recognizes the divergence between price and fundamentals, and we see a reclaim of the 10 and 21 exponential moving averages. From there, each Fibonacci level provides a roadmap higher. If Ethereum enters a strong bull phase and DeFi narratives catch momentum, SNX could ride that correlation toward upper targets, given its infrastructure role in the ecosystem. Worst case, weekly close below the channel invalidates the structure. At that point, we're in uncharted territory with no clear support levels, and the path of least resistance is lower. Volume could dry up, confidence could break, and we'd enter a longer reaccumulation phase at levels below the historical low. This is why the stop exists, to prevent a value trade from becoming a disaster. The timeline here isn't days or weeks, it's potentially months. The fundamentals are building foundations, but markets don't reward fundamentals on short timeframes. They reward structure, momentum, and narratives. Right now, structure says downtrend until proven otherwise. The bet is that fundamentals eventually matter.
And when they do, being positioned from deep value gives you the best risk-reward. What would change my thesis? A weekly close below my stop invalidates the long case. On the flip side, a weekly close above the 0.236 fib with volume confirmation would suggest the channel might finally be breaking to the upside. Until either happens, I'm patient in the accumulation zone.
Synthetix is giving me the same setup that worked before. Accumulation zone, descending channel structure, bearish sentiment. The difference is the protocol underneath is stronger. 2.5 billion in competition volume. Mobile trading live, 9 new markets, ecosystem incentives expanding. Chart says be careful. Data says value is being built. My strategy? Accumulate the zone with a stop below the channel. Targets mapped to Fibonacci and previous resistance. Either fundamentals start pulling price up, or the pattern wins and I take a controlled loss. That's how asymmetric setups work. You lose small when wrong, win big when right.
If this analysis helped you see something you missed, hit the like button. It pushes this to other traders looking for data-driven setups. My free Telegram has faster daily market updates. Link in the pinned comment. Thanks for watching. Never financial advice, and stay disciplined.